Okay, so this chapter is all about individual deductions, and I have a lot of different printouts for you guys. These are all online in Blackboard for you. I put them under the Documents tab in the event that you did not hang on to them, or don't hang on to them, I should say. But I wanted to have copies so that we could also talk about them today as well. So, the first one we're going to talk about as we go through these, there are several different, now these, several of these we're going to talk in more depth as we go into different chapters. For example, Schedule C. We're going to talk a lot more about the Schedule C. Right now we're just going to kind of introduce some of these. So as we get going here, all right, so to some of our learning objectives, we're going to talk about, we're going to come down to why would we take the itemized over the standard deduction, and then how do we compute itemized deduction. So there's 3 different categories of deductions for AGI. Those directly related to business activities. So this might circle back and kind of help you with the 1040 if you didn't already do it. Indirectly related to business activities. And then deductions that are subsidizing specific activities. These are all for AGI. And do you remember what for AGI means? It means above the line or the first page. Okay, above the line or the first page. All right, that's either way you want to look at it, that's what it means. So we want to make sure we're talking about the same thing. So a Schedule C is on the first page. So directly related to business activities means you get to deduct it. It means you get to go out there, and if you made $10,000 in business and it's directly related, then you get to deduct it from your business expense. Something that not everybody did on that homework problem. All right. For tax purposes, it's profit motivated or motivated by the personnel who works for it, and it can be classified as the trade or business. So it's something that you can directly link. All right. Now, business activities need to be distinguished differently from investment activities. All right. There is a difference between the two. Trade or business activities involve basically you're highly involved. One of the things that you're going to read, or when you're doing taxes, one of the things you're going to see is, were you, I just lost the word, materially involved. That's not the way it's phrased. But were you materially involved? Were you actively involved? And they're looking for, were you, if the answer is yes, then you're looking at a business activity. Or investment activities are things like maybe rental property where you're not doing anything. If I own a condo down in Gulf Shores and we rent it out, how active am I going to be? Do I actively participate? That's what the word I was looking for was. Okay. Do I actively participate in the renting of that condo down in Gulf Shores? Chances are the answer is no. Yes, I could. I could be the one who rents it out and does all the scheduling, but that's not very likely from St. Louis. Chances are I have a management company that I pay that does that. So therefore, my active participation is probably not very much. And so that would then be reflected on the Schedule E. All right, so there's our 2 different business activities. If we're a business, we're self-employed, okay, and then we get to deduct it from AGI. If we are doing it for a business in which we work. Now, the difference here usually is, for example, the college. I work for the college. If the college does not reimburse me for mileage, then that mileage is going to be a deduction from AGI under unreimbursed employee business expenses, because I'm an employee of the college. I'm not self-employed. If I were an adjunct teacher, or I was doing consulting work outside of the school as another job, and then I was doing travel between companies, that would be self-employment. So you got to distinguish. So if I want to deduct my miles, but the college reimburses me. But if they didn't, that would be from AGI. Same with investment activities. Rental and royalty are deduction for, but then other type of investment expenses are going to be a deduction from. So what kind of trade or business? All right, so we're going to look at, and I do have, there's a couple different forms we're going to look at. The first one we're going to look at is a Schedule C. And I did these front and back so there's just one form. Now, if you did your homework, then you didn't do a Schedule C necessarily, but you do know that it flows on to the 1040 on line 12. All right, that's where it flows to. So what are we looking at? Revenues are reported exactly the same. When you're looking at this Schedule C, you're going to be looking at saying, okay, my gross revenue goes on line 1. All right. Any type of returns and allowances, any type of cost of goods sold, I'm going to come up with my gross revenue. So depending on your type of business, your line 1 might be exactly the same as your line 7. All right, a lot of small businesses, that's the case. Then part 2 is where you're going to have a lot of your detail. And we're going to go into a lot more detail on this when we get into the business chapter. But what we're looking for ultimately is when you get down to line 31. Line 31 is what's going to flow to line 12 on the 1040. That is going to be your income from your Schedule C minus your expenses is what's going to flow to your 1040 on line 12. Now, if you turn it over, there's a couple things on the back side of your Schedule C. They're not quite as common. The cost of goods sold, obviously the only reason you're going to have a cost of goods sold is if you're selling a product, all right, not a service. Now, the vehicle, part 4, is, and we're going to talk a little bit more about vehicles here, but this would be filled out anytime you're using a vehicle. And that tends to get missed sometimes, so I'm giving you guys a hint that are here. Right? If you're doing a Schedule C for me and there's a vehicle, I expect that part to be filled out. So you're going to put how many miles you do for business and then how many total miles you do. And then that just transfers to the other side. Then you do have to take those miles and calculate it based on the mileage rate. The other thing that's, if you go up to the very top of the Schedule C, you have to do a Schedule C for each business. You cannot have somebody that has 2 different businesses, which sometimes is common for someone who's working from home or trying to run several. Then they have several Schedule Cs. You can't just be, oh, they run 2 different businesses, let's plop it on one. Each business has their own identification code. Each business is going to have their own income and their own expenses. So if you have 2 businesses from home, you do craft fairs and you do daycare, then you're going to have 2 Schedule Cs. Right. So that's what we're looking at when it's flowing through on the Schedule C. So expenses are claimed, revenues are also reported, and it's going to flow through to line 12. Royalties is a little bit different. Here's a Schedule E. Now notice all these forms say 2015 because they have not been released yet for the new ones. So hopefully we will get the new ones before you do your project, but there's a good chance you're going to be doing a lot of these minus the 1040. 1040 should be a 2016, but the rest of them might not. The reason I like to give you guys these is because sometimes when you pull them up to do your homework and stuff, I want to make sure you get the right form. So when you pull these up ahead of time, you know what it should look like. Now, the rental and royalty, if you notice, it's going to flow to line 17. 17 on the 1040 says rental real estate, royalties, partnerships, escorts, trust. All right, so there's quite a few things that can be on here. This is still above the line. There's a lot that can go on this little guy. Notice at the top it just says supplemental income and loss, whereas the other one said business income. The other one is pretty specific. This one can have a lot of different things on it. So at the very top, the first thing it asks for is what's the address of what we're talking about, because it's going to be some type of investment activity or trade activity. That's what goes on here. Then it's going to say what kind of property was it. Now, if it's rented, it's going to go in this column. If it's not, you're not going to have anything here. And then you're going to go down for rent and royalties. So, for example, if you're, I'm trying to think of an example. Somebody comes in here to get their taxes done that actually the grandpa left them when they were young. He bought them like a piece of farmland in Illinois that has oil. And they sometimes will get $10 in a year, and then other times they'll get a check for $400 in a year. And it cracks me up because when I drive to Illinois every once in a while, you'll see those little oil pumps going. They got one of those. So it comes on royalties, and we fill out a Schedule E like this. So when you come down to line 4, that's where we put the royalties, how much royalties came in. At the same time, if it was rent, it would go on line 3. You can also have expenses. In this case, she has none, but you could have expenses, especially if it's rent. All right, you would have the different rent. That's where you really have the management fees and all the other expenses, but you could have it on royalties as well. If you flip it over, part 2 and 3 are partnership, S corps, and estates and trusts. So you get more detail on those on the back side. But all of it's going to flow back over eventually. Rental real estate and income finishes on 26, and the other ones flow over onto the back, and farm is actually summarized on the back as well. So this is a very busy form. It's used for a lot of different things. We actually have someone who wrote a book, and his royalties from that book would also flow onto here. Because if you write a book, every time you sell that book, you get X amount of money. That's royalty. That also goes on here. So that's another example of something. So we got business income, and then we got rent and royalty. So again, that as well as our flow-through entities, those S corps and those partnerships would flow on that same piece of information. Okay, now these deductions, the one thing, especially with the business income, we got to remember, and we already talked about this a little bit, a business can do very bad, but the most we can ever deduct when we're looking at things, taxpayers disposing of trade or business, they're allowed to deduct a loss for AGI. Losses in investment, or capital assets, are offset against the gains. We talked about that. A net capital loss is deducted, but never to exceed $3,000. So when we look at line 13, capital losses cannot exceed the $3,000, which we did talk about. We can carry those forward indefinitely. Now, when you're looking at a business that has losses, we got to look at some of those losses are allowed in big chunks. At the same time, we got to look at, like on rental property, if it's a passive activity, which we'll talk about after the midterm, a passive activity, you're only allowed to deduct a passive activity if you have passive income. So you're not necessarily allowed to deduct a loss on a rental property unless you have income from a rental property. I know that sounds kind of counterintuitive, but we'll talk a little bit about that once we get to that chapter. So you can deduct losses, but not necessarily all your losses, and you can't. I mean, obviously, you're not in a business to lose money. There are tax advantages to having a business that loses money because you can deduct those losses, but that's not why any of us go into business is to lose money. I would hope.
Like the gambling. Right?
Like the what?
The gambling.
The gambling?
Yeah.
Okay, that not here. All right. Gambling, we do talk about gambling if you win, would go on line 21, okay, as other income, and then the losses go on the itemized deductions.
But you deduct the losses if you don't have them.
Right, that is true, yeah. You can only deduct the losses if you win. That is true. Yeah, so it's kind of similar for that. All right, so deductions indirectly related, we got one called moving. All right, so this is kind of related to your business, maybe not. So if you're looking at your 1040 here, we did move a little bit. We've now moved down to those numbers that are adjusted gross income, adjustments to income. So we're in the bottom little part. We're still for income, or for AGI, but we're down under what's called moving expenses, and we're on line 26. Now, you have to be moving for work, okay? You can't just move. And I know that sounds like that's kind of self-explanatory, but one of the first friend income taxes I did, I got a call from Texas when my husband and I got married, and it was a friend of ours, and they just moved down there, and he said, I'm not feeling very good about our taxes. I'm like, all right, what's wrong? And he said, well, we went in to get them done, and there was a line, and the guy told us to sit down. He didn't make me feel very comfortable. just everything about him. He was kind of dressed a little funny, but I'm in Texas, so I didn't know what to expect. And we sat there. We waited an hour and a half. We sat down. He did my taxes in 15 minutes, and we were done. And I'm like, okay. And he goes, and Sherry just moved here, and I just thought that was really quick. And I'm like, it is really quick. He goes, well, you look at them. And I'm like, yes. So he mailed them to me, and he deducted her moving expenses. So he lived in Texas already. She lived up here. They got married. She moved down there, and then she got a job. Can she deduct her moving expenses? No. All right? Now, if she would have gotten a job that moved her to her husband just coincidentally, then that would have been just a lucky coincidence, and then she could have deducted her job. But no, she got married, moved to Texas. She's a teacher, got hired as a teacher. And I told him, I said, listen, no, you can't. I said, will they come back? I have no idea, but no, this is not right. And I don't know if the guy's a CPA that did it, but that's not right. So they actually amended and paid back the amount of money that they got, because you can get a decent chunk with moving expenses. And so he did not want to get caught up in that. So it seems self-explanatory, but obviously even when you go to a tax place to do it, they might not get it right. So you do have to move for work. You have to meet 2 tests. The first is a distance test, and the second is the business, which I just talked about. So with the distance test, you have to move 50 miles past where you currently drive for work. All right, so if you already drive 12 miles to work, and I always want to make sure I say this right, if you already drive 12 miles to work, you now have to drive, no, not 52, 60, okay, yeah. Yeah, I'll make sure I'm saying it right, okay. So you have to go more. So it doesn't matter that, so if your business moves on you, so you could benefit, from, let's say, okay, when they were getting ready to do well, they're still getting ready to do it, but they're talking about moving the government building downtown, which is like, I don't remember the exact name of it, but it's like the defense mapping building for the government. It was a big deal. Whether or not they were going to put it in North County, in West County, which went away real fast, or over at Scott Air Force Base. All right. So North County won, or North City technically, I guess. But if they would have put it at Scott Air Force Base, would that have gotten 50 miles? I'm not sure that's 50 miles, but let's say it was. Okay. If that would have expanded the drive for people by 50 miles, then they could have technically gotten a break. I don't think it's 50 miles, but it's not. It's a little drive. So that's what you're looking at. So, but most of the time, in order to get the move, you actually have to move to get an employee. So when you do that, you get several breaks. Okay. So the other thing you got to do is you do need to work. You got to stay working. All right. 39 out of 52 weeks, or if you're self-employed, it's 78 out of 104 weeks following the move. So you can't get moved to Oklahoma City, take a tax advantage, and then say, I'm done. And then say, okay, that's great. You'd have people all the time saying, oh, I'll take the move to California, right? Get moved out there, take the tax break of some sort, and then quit the job. You can't do something like, I'm not sure that would be smart anyways, but you can't take it. And then you could choose to, instead of taking the deduction for your car, the actual miles or something, you could take the 19 cents per mile. Now notice that is not our normal mileage, but for moves it is different mileage. All right, you'll find there's a different tax rate for moves, for charity, and for health. For health, there's a different move than what we use for business expenses. Okay, so let me ask you, where did I just go? Okay, so looking at an example on page 6.5, as long as I'm looking at the right example. No, I'm sorry. Page 6.7, it's example 6.4. There's just a couple examples of ways we can move, so just to kind of make sure we all got it. Before moving to Kansas City, Courtney lived in Cincinnati, where she commuted 10 miles to her workplace. The distance from her home to her place of work in Kansas City, her new place is 580 miles away. Can she deduct living expenses? moving expenses, sorry. Well, obviously that one's pretty cut and dry. She just moved 580 miles away. But now let's look and say, suppose that she started a new job at an office just outside of Cincinnati, and because of the new job, she moved houses. The distance from her former residence to her new place of work was 12 miles. The distance from Courtney's former residence to the new place of work is 55 miles, sorry. Does she meet the distance test? No. And obviously they explain right there, but the bummer is on this one, her increase only went up by 43 miles. So she's shy by 7 miles. Or she could deduct the moving expenses. So even though she moved, she needed to move 7 miles, or she needed the work to be 7 miles farther. And then the last one, suppose that Courtney started a new job at an office just outside of Cincinnati and moved into her new residence. If the distance from Courtney's former residence to her former place of work was 12, and the distance from her former residence to her new place of work was 80, then would she qualify? And the answer is yes, because she's obviously over that. So you just want to, I mean, a lot of it, once you get that 50, it's pretty self-explanatory to figure it out, but you got to get to that 50 and make sure you remember that amount. Okay, the next thing, before, as we're still going, we're still on the front page here. And then we got 4. We're still 4 AGI. The next thing we got goes along with self-employment. And we got our wonderful self-employment tax, which has its own form. Now, self-employment tax actually has a short form and a long form. The short form is on the front page, the long form is on the back page. For the most part, you should be able to use the short form with me. You should not have to use the long form. I'm not telling you that that's a given, but for the most part, you should be able to. And it says on here, there's a little flow chart on when you should have to use the long form. And it basically just talks about your wages and your tips, and did you receive any type of Social Security Medicare that you did not report. But notice what it looks for. The first line says, did you have any type of Schedule F or Schedule K? So right away, if you're doing a Schedule C, you don't have 1A, you don't have 1B, you go right to line 2. That's where you put your Schedule C information. You combine it, and then notice, we take our Schedule C income and we multiply it by 92.35%. So we're not taking all of it. We're taking 7.65%. Or all of it but 7.65%. Now, for some reason it's less than $400, then it's different. Okay, now, we're going to look at that number on line 4. And if it's less than 118,500, we're going to multiply it by 15.3 and enter that result on line 57 of 1040. And then if it's more than that, we're going to multiply it by 2.9%. Right, so line 4 is going to be the number multiplied by 92.35. And then, depending on what that big number was to begin with, it's either multiplied by 15.3 or 2.9. That number goes on the back side of the 1040. We haven't gotten there yet, but it goes on the back side of 1040, and that's included with the taxes that we are paying. Okay, so when it sits there on the back side of the 1040, line 57, self-employment tax, that's going to get added to the amount of tax that we are paying. But then the last thing it says is take 1/2 of that and put it on line 6, and then take that and put it on line 27. Line 27 says deductible part of self-employment tax. So what they're doing is you have to pay tax on your income. You are paying Social Security, you are paying Medicare, you are paying your half of Medicare, plus you're paying the business part of Medicare. That's why it's 7.65 is coming out of that, okay? But they're giving you a break by letting you deduct half of it from your income. So that's why you're paying all the taxes on the back, but you're deducting half of it from your income. So it's not a one-for-one break, because then you just pay half, right? But you're deducting half of it from your taxable income. So that's what you want to make sure you do. So then when you get down here, we're not quite there, you'd come up with your AGI. Now if you have to use a long form, it's a little bit more in depth. I'm not going to go line by line on that, but if you do have to use the long form, it's going to be because your wages are subject to tips, or you're on the railroad, or your tips had Medicare and Social Security that you did not report, or you had uncollected Social Security. Yeah. You got mine. Yours too. Okay, hang on. You guys got my 2 pieces of paper instead of... Okay, so that's our self-employment. The other thing that you can do is, by being self-employed, you can deduct health insurance that you give to your employees. So if you give employees health insurance, that might show up on your Schedule C, but it also is a deduction that you can receive as even though you're giving it as a fringe benefit, it can also go online. I just lost it. It doesn't say it on there. Give me a second. Health savings, health insurance. There we go. 29. So you can also deduct health insurance provided for the taxpayers and dependents who are not eligible for other employer-provided health insurance. So if you're self-employed and you're providing that. Penalty for early savings. This is not the 401k. That is probably one of the biggest mistakes, is when you put on line 30 and you have a 401k and you take an early distribution, you pay that 10% penalty. That is not this. All right? This is when you take an early penalty for a savings account or a CD or something at the bank. This is not something from an IRA. This has nothing to do with an IRA. I have never seen anyone get a penalty here. In all the taxes I've done, I've never put a penalty here. I put a penalty on the back, but I've never seen the penalty go here. So be very careful with that one, that you don't mistakenly put it there. And then here's our self-employment that we already talked about. And then alimony, which leads to your question that you looked at in the homework, right? All right, alimony payments are deductible for AGI, basically to maintain equality, because if you're paying someone alimony, then why should you have to pay tax on that amount of money? Just like the person that you're paying it to has to declare it as income. So you don't pay tax, but they do. So that is deductible on line 31, and you do have to give the Social Security number of that person so they make sure that you're deducting it and they're paying it. So you can't get away with this was much easier to get away with this before we were automated tax returns, right? All right, contributions to a retirement account. Those are encouraged. So obviously when we're trying to do it, that's line 32. All right, we will talk more about that. An IRA deduction is limited based on your income and based on what you're already contributing, maybe through work. Then with the next two, we got interest expense on qualified educational loans or student loans, and then we also have qualified educational expenses. So interest expense, you can deduct up to $2,500 of student loan expense, of student loan interest expense on your taxes. It is subject to phase out. There is a schedule that you have to, it's not just I can do what you do, have to go look at a schedule. I'm going to show you what it is in a second. It is phased out based on $65,000 for single, $135,000 for joint. It stops completely at $160,000 for joint filing. So this is what it looks like. So when you're looking at, if you're under $65,000, you get to deduct the whole $2,500. That's if you have it. Now, if you only have $1,200 worth of student loan interest, then you put $1,200 worth of student loan interest. But if you have a $2,500, you get the whole amount. If you're somewhere between $130,000 and $160,000, or $65,000 and $80,000 if you're single, then you're going to use this phase out amount, which you come down here, and depending on if you're single, head of household, or married, it's going to be whatever your modified adjusted gross income is minus 130,000 divided by 30,000. So it's a percentage. That's how they come up with this wonderful amount. All right, it's a very weird, oh, I'm sorry, I did that wrong. Modified adjusted gross income minus 130,000 divided by 30,000. So they're going to take whatever it is. So if I make 140,000 combined with my husband, then I'm going to have 10,000 divided by 30. So they're going to take a third of my 250,000, and that's what's going to be deductible. All right. So that's how they're going to come up with what amount I can deduct. And so the more I make towards 160, the less I'm going to be able to deduct. So of my 2,500, a third of it is going to be excluded based on that formula. Now, the other one that we talked about before I went to this was let me go back one more. Was qualified education expenses, and they don't have another slide on it, so I want to go back to it. This, we're going to talk about the credit for education when we get to that, to the second page of the AGI, of the tax form. But you don't have to, in some cases you can't take the credit. And if you can't take the credit, then there's an education deduction, and that's this. You can take up to $4,000 education deduction, but you can't take the credit. Okay? That's husband and spouse, that's kids, and usually the only reason you're going to take a deduction is if your income is too high, that you don't qualify for the credit, or I think because a lot of times the credit is non-refundable if you're lifetime. If you're American Opportunity, it's a refundable credit, which we'll talk about, but lifetime, it's not. So if you get and you don't have a taxable income, then you're not going to get the credit. This isn't going to save you either. But some of those credits are phased out, so sometimes you can take the education deduction and you can use it that way. Actually, I said 4,000. It's 2,000. All right, I gotta go backward. I went too fast. Okay, what did I just do? Sorry. Trying to figure out where I was. We were here, right? All right, we did that. Sorry about that. We did that. I don't know what button I hit that closed me. Okay, so now let's start talking about, that's our last before we get into from AGI. All right, so from AGI, it starts talking about itemized deductions. Now, itemized deductions are going to be on the second page of your 1040. Going to be on line 40. And this is where you're going to take the higher of your standard deduction or your itemized deduction. Usually, the reason you're going to take itemized deductions is because you have either medical expenses and or a house. Right? You usually do not take itemized deductions unless you have one or the other. Only because it just usually doesn't amount. Now I say usually. I know someone that I don't remember if I mentioned this before, but she's a pet sitter. And so what her job is she walks pets and takes care of pets during the day. She is not reimbursed for her mileage. So her mileage is extremely high because that's all she does. So she doesn't own a home and she's not sick, but her, and we'll talk about it in a second, her unreimbursed mileage well exceeds her standard deduction because it jumps out on itemized deductions. So that is a case where she doesn't have either one and she does use itemized deductions. Okay, so medical expenses. You can deduct them for yourself, your spouse, or your dependents. But it has to be one of those three. They have to be qualifying medical expenses. Medical expenses include unreimbursed payments for care, just normal everyday things that we would expect, prevention, any type of bodily functions or disease or injury. But it's kind of gotten where there's a gray line a little bit for what is considered okay and what's considered qualifying. So in your book, on page 614, there's a little thing that's called taxes in the real world, and it's kind of interesting. It says, while cosmetic surgery is generally not deductible, discretionary medical costs may be deductible where the procedure affects the structure or function of the body. So if you think about that for a second, if you think about someone that's maybe born with a cleft lip or any type of physical impairment or has a bodily injury where they then need cosmetic surgery, so like a fire or something like that, that would then be considered something that would be a qualifying medical expense, but yet it's cosmetic surgery. It goes on to say that there's a couple different rules. And one of them that they were talking about is pregnancy infertility. And should that be considered a qualifying medical expense? And it says it ruled that the egg donor fees and expenses related to obtaining a willing donor, paying a taxpayer who could not conceive using her own eggs, qualified as a deductible medical expense because they were incurred in the preparation of the taxpayer's medical procedure, which was the implementation of a donated egg. So those were considered to be a qualifying medical expense. So it was egg donor fees, expenses related to obtaining the donor, and those paid by the taxpayer would be who could not conceive using her own eggs are considered to be a qualifying medical expense. It said deductible expenses included the donor's fee for her time and expense in the following procedures to ensure successful egg retrieval, the agency fee, procuring the donor, coordinating the transaction, expenses for medical and psychological testing, and assistance of the donor before and after the procedure, and legal fees between the contract. All that was considered medical. And then it says, what about the same type of expenses by a single male to a father, a child, through a surrogate? Would that be considered qualifying? A single male who wants to father a child for a surrogate, would that be considered? And are those expenses deductible? And the answer is no. And it says the answer is because in that situation, the expenses are not related to an underlying problem or a defect. Whereas the mom who could not produce her own eggs to have a kid had a defect, for lack of a better word of saying it. Therefore, it was a qualifying medical expense to go out and have eggs implanted to have the kid. Whereas a single father who just wanted to surrogate could produce his own eggs, he just didn't have anybody to implant them in. So that's not considered a qualifying medical expense. So you can only imagine in today's world how qualifying could be very broad. So my only advice to you is, if you're doing taxes for somebody and they come to you with what they consider to be qualifying and you're on the fence on whether it is, you can do research. As you can, if you look at this one, there's an IRS letter ruling with this one on the pregnancy. There's also a memo on the dad with the surrogate. You could do some research if you don't think it's a right thing to do, or if you're kind of questionable either way, you can let them know that you're going to deduct it, but they need to keep some detailed documents on their expenses because you're not sure that it's going to qualify as a qualifying medical expense. Because remember, part of doing a taxes is being an advisor to them and letting them know what you think and what you don't think and letting them know how you want to proceed. So that's something that we have to do as well. And then taxpayers can also use your personal automobile as transportation, and you can deduct that mileage as well. Now, technically, each one of us, every time we go to the doctor, every time we go to the dentist, every time we do any type of trip, we could keep those miles and put them on our tax return. The thing is, most of us don't have enough medical to ever deduct it, so we don't. But I know my parents keep their mileage. because they do have enough medical to deduct, and so their mileage just adds to it. On top of that, they live down in Bonne Terre, which is like an hour away from here, but they see quite a few doctors up here as specialists, maybe 3, 4, 5 times a year. So that's a 60-mile up and a 60-mile back that they get to deduct. So that adds up. And I was really surprised. If you're ever at the hospital or you're ever at a specialist, not just your primary, sit there and listen to when people come in and they say where they're from. If you're at a specialist and you're not, listen, they're not from here. They're from, down in Cape Girardeau, and they're from out in the middle because they have to come to St. Louis. Unless they're closer to Kansas City, they've got to come into St. Louis to get to the bigger hospitals to see a specialist. My son's had a ton of hip surgeries, and we've been down at Children's Hospital with a pediatric hip specialist for several years. We've gone a year with no hip surgeries. And but when we're down there and you listen, it's just kind of like, it's just all over the place where they're coming from. So we're unique in the fact that we live here and we can just drive 5 miles to go see the doctor. But if you listen around, they're driving a long distance, and those are the ones that are actually keeping track of their miles. All right, you can deduct your medical costs in the hospital, which seems reasonable. You can also do your long-term facilities. My grandmother was in a nursing home for medical reasons, not because she was tired of living on her own and checked into an assisted living. All right, you need to be in there for medical purposes, which she was, and it was 98% tax deductible. I say 98 because she did have cable. I'm not sure if she really watched it, but she did have cable, and she still got her hair done, and we still did little pet manicures and stuff on her. Those were not tax deductible. So when I got the bill at the end of the year and I did her taxes, I had to go through each month and take out the cable and take out the hair and take out the nails. But 98% of it was tax deductible. So basically her entire living was tax deductible, but it basically took her entire income to take her entire living tax deductible. So all that is. The biggest thing that you got to remember when you're going through all these is it's subject to 10%. 10%. It has to exceed 10% of your AGI. So one of the biggest questions I get from people when you're starting to do taxes and they're not older is, okay, I've been keeping track of my medical. And I usually start looking at them, I'm like, okay. And they're like, and they give it to you every year. And I try to tell them, okay, think of it this way. If you and your spouse make $100,000, you need to have over $10,000 in medical expenses before you can deduct a dime. So if you had $10,050 in medical expenses, I can include $50. And then they're like, oh. And I always use $100,000. I just recommend you use that or 50 because it's a round number. So if you're doing a single person, you can say $50,000. And if maybe they make 30, but now that it's 10%, it's a little bit easier. When it was 7.5%, I'd always say $100,000. You have to exceed $7,500 in medical. And they'd always be like, oh. Because someone that has decent health care, unless they have some type of catastrophic issue, it's going to be very hard to exceed that amount and have anything deductible. If you don't have good health care, you're going to be there quickly. If you don't have health care at all, you're going to be there quickly. So that's something just to tell them. Now, 10% for most of us, 7.5% for those that are over 65. All right, so the next thing down on your itemized deductions, that is the first, I like to call them boxes. They're not labeled boxes, but that's the first box on your Schedule A is medical. All right. So then we go down to taxes. We have state and local. All right, and what they mean there is you have your income tax, and then notice, I don't know if I'm going to be able to switch between the two. I might show you at the end, don't let me forget, but it's going to be hard for me to switch between the two on here. We have state and local, which is pretty self-explanatory. It comes on your W-2, all right? But if you're not working, or if you're retired, so therefore you don't have state taxes coming out, there is something, if you look on there, that says general sales tax. General sales tax can be if you bought a car, if you bought a boat, if you bought a motorcycle, you bought something big, then you might want to look at that, especially if you're not working very much. Or if you're not working at all, there's a calculator that you can pull up that will help you calculate approximately how much you spent in sales tax. So when you have a retired person that hasn't spent any money on a W-2 in sales tax, you can go out, and state tax, you can go out and calculate what their sales tax would have been, and then they will have something going on line 5. Because if they're itemizing due to a house or doing the health care, you might as well figure out what their sales tax estimated could be and add another $400, $500, $600 on there. So I will show you that. Line 6 is real estate. That is when it could be rental, all right? But rental is going to flow to your Schedule E unless you use it for personal use also. But that's basically your home. You can have it could be a condo that you have, it could be your home, it could be your second home, all right? This is, now in mortgage interest, we're going to get to in a second, but on taxes, you can have multiple homes, and if you pay the taxes on them, then you can deduct it, right? Personal property tax is your car, your boat, or property. That is not your home, all right? That goes on line 7. That's usually a little bit less than the big one. And then other taxes could be something else that could be assessed or could be Missouri. We don't usually have much that flows there, but you could have something else that flows. And then, like I said, when we're done, remind me, I'll show you that calculator for sales tax. So under interest, you have a couple things. Under interest, there's several different lines. The first 3 lines are all the same thing, just depends on how they're reported to you, right? A 1099 is sent to you if you own a home and you paid interest on it. There are people, especially as they get older, that have paid off their house. If they paid off their house and they own a home and they don't have interest, so they might just have real estate taxes, which I will tell you during the VITA program, is one of the most commonly missed things is if you say, do you have a home? And they say, yeah, but I paid it off, then we forget to ask them for their taxes. All right, so you got to make sure you still ask for taxes. But mortgage, you can deduct 2 homes. Main home, secondary home. If you have 5 homes, tough, okay? 2 homes. You can do up to $1 million of indebtedness, meaning if you're nice and wealthy and you can have a couple homes of over $1 million of debt, you only get to do interest on up to $1 million of indebtedness. You can also include in that what we call a home equity loan, which is a secondary loan on your home. Those are very common for most of us, all right, where we have a house and then we take out a secondary loan. It could be $5,000, it could be $20,000 or whatever, and that loan can be up to $100,000 in interest, all right, on the debt of $100,000. So those two combined, that either goes on 10 or 11, and it just depends on whether it's reported on a 1098 or it's not reported on 1098. Line 12 goes with the 1098, but it's points. You don't see this quite as much right now because our interest rates are extremely low, which is wonderful. But points are where you can pay what's called a percentage point. It's usually like how did it work? It was usually like you could drop your interest rate by 1 point by paying 1% of your loan. So if your loan was $100,000, you paid $1,000, your interest rate could come down. All right, now how much it came down, I think depended on where interest rates were. I can't speak exactly. But that's when interest rates were higher. I mean, my first condo, I think when I first got it, was before I got married, I think interest rates were maybe like at 8. And then when my husband and I first got married, I think they were like around 6 or 7. And now you're anywhere from 3 if you were good, which we were in the high 3s, to high 4s. So people aren't paying a point because they're low already. But that's where it would go. If you paid a point, you can deduct the point, and there's certain rules. You can spread it over the life. You can deduct it in the first year. Line 13 is what's called mortgage insurance premiums. If you do not put down 20% on your loan, you have to do something called PMI, all right? It's private mortgage insurance. You now get to deduct that there, which is nice. Line 14 is the 2 top things up here, this itemized deduction for investment interest, right? That is when you have investments, which is nice. You can deduct the interest, but it's limited to your investment income. You cannot deduct more interest than your income coming in, which sounds about right. Any investment interest in excess of the investment income limitation carries forward to the next year. All right, my next box, charity. All right, there's a couple different limits on this. They sound really confusing when you talk about them, but they're not. All right, first of all, you got cash. That's the easiest one. I always tell people when you're doing someone's taxes, don't give cash. All right, the Salvation Army's cash. All right, that's normal. But when you're giving money to church, don't give cash. Give a check. We've had people come in to do VITA, and what'd she say last year? Oh, I gave $2,000 to my church. And we're like, okay, well, do you have something from your church saying, no, I didn't want to bother them. Well, do you have your checks? No, I gave cash. Okay. And so in VITA, we're under the unique where we can, if we believe her-ish, we can go ahead and do it. And we just said, you realize that if you're audited, you're going to have to provide proof of that $2,000. And she's like, well, I gave it to them and blah, 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 and my church. We said, okay. And we did it. And then we told her, you should not give cash, and you absolutely should bother your church to give you a receipt. My church sends one out once a month and tells me how much I give. And even when I give cash, I put it in an envelope, and I say my name so I can get a receipt. So always encourage the people that you do taxes for to give checks or pay by credit card, when they can. The other one is when you give property. That's where it gets a little bit trickier. So there are a few limitations when you're looking at property. This is where I said it sounds tricky, but it's not tricky, really. The charts are actually on page 623. I actually think on 622, it actually looks better than it does up here. First of all, when you look at charity, you can never give more than 50% of your AGI. All right, which makes sense, right? If you make $50,000, you cannot give more than $25,000 to charity. You cannot deduct more than half of what you make in charity. The second thing is there's what's called 30% contributions. Those are where you take then the lesser of your AGI times the 30%, or your AGI times 50%, and then minus the contribution subject to that 50%. Now, what you got to look at, and this is what I was saying where your book is a little bit better, is what are those 30% contributions? Your 30% contributions are things like capital gain property. Are you giving stock? Okay, are you giving stock to a charity? Which, I don't have enough stock to do that, but people do give stock to charities. So if you are, that could be a 30% deduction limitation. And depending on if you give it to a public charity, it's the fair market value of the stock. If you give it to a private charity, it's the basis of the stock. And then there's a step 3, apply limitations to 20% contributions, which is, and then there's 3 steps, AGI times 20%, AGI times 30% minus, and AGI times 50%. So very similar to the one. Well, there you're going to step in ordinary income property, which is other property that we have, not the things that we give to charity, okay, ordinary income property. And it's going to be the lesser of the fair market value or the basis if we're giving to public. So what you and I see and what you and I give, for the most part, is going to be items such as cash and items in our home. They're going to be subject to the 50% limitations. They're not subject to the 30, they're not subject to the 20. But they could be. And there's more in here when you get looking at it on what's considered ordinary income. Ordinary income is when you sit there and look at all the other assets, including the capital gain property and such. But you want to be very careful when you're talking to people about what they're going to put on line 17. If it goes over $500, then you have to complete what's called an 8283. A Form 8283 lists the charity that you gave it to, how much you believe it was worth when you bought it, which is very tricky, and how much you believe it's worth now. Now, the tricky part about that is when you start doing people's taxes that give things to Goodwill over and over and over again, and all of a sudden they got $5,000 worth of stuff they gave to Goodwill, and maybe it's completely legitimate. I'm not making up 5,000. You now have to fill out an 8283 for every donation, and you got to list how much you think they spent and how much you think the fair market value is of those items. And when you talk to people, they really think the fair market value of their items is much higher than it really is. Because when you give it to someplace like Goodwill, the fair market value is not what you could get if you were to walk into a store and buy it. It's what would you get if Goodwill was buying it from you. And if you go, usually it's a garage sale. It's a garage sale price, maybe stepped up. Now if you have really nice stuff, then you might be able to say, okay, what if I took it to a consignment store? What could I maybe get then? But you still gotta I gotta step people off that shelf a lot. You know, when they're like, well, this is like $600 worth of pants. I'm like, you gave me like 10 pair of pants. That is not $600. Well, they're all like $100 each. I'm like, yeah, and now they're probably $20 each. You know, what is someone gonna pay for used pants? They're not gonna pay $80 just because they say whatever on them. So you gotta kind of walk people through this. You gotta remember, you're the one giving them that voice of reason, believe it or not. All right. So where did I put it? Okay, so I want to give you an example. All right, so Sabrina loves fashion, but she is also very charitable. Every year she donates her previous year clothing to Goodwill to make room for her new fashions in her closet. Must be nice. Sabrina estimates that the value of her donations is approximately $6,000. She recently learned that because her donations exceed $5,000, she must get an appraisal with her donations, which takes it up to another level beyond $500, and a signed statement from the appraiser on her 8283 because of the value. Sabrina decides to claim a charitable donation of $4,900 to avoid the appraisal requirement. What do you think of her decision? Is that an ethical decision? So she knows if she says 6, which is what she thinks it is, she needs to get an appraisal. So she's going to go ahead and say 49 so she can skip the appraisal part. Now she's still going to have to fill out an 8283. What do you think? Well, exactly. Could she really be overpricing it in the first place? There's a good chance of that. I'm not sure on the ethical side where that falls. Because I agree with you. I'm not sure if she really had a good price in the first place. Well, let me ask you this. Do you think that there is an abnormally large number of contributions that are just under $5,000? Probably. What do you think the IRS does with that? Do you think they pay attention to it? Do you think they look at it? Do you think they don't care? Do you think they go out and look at those that are just under $5,000 and say, we're going to audit those guys? They don't randomly audit, but do you think they look at things like that?
They probably look at it, but they probably also take into account your overall income. It's like, how feasible is it for you to give that much away?
Okay.
If you're only making $40,000 a year, you're not going to do it.
Okay. You're not going to clean out your closet every year on $40,000?
Well, not yet. I'm not going to spend $60,000 on clothes every year so that I can give away 6 either.
Now, what do you think, Sabrina, if she really thinks her clothes are worth 6, is she better off getting the appraisal and doing 6 versus $4,900? I mean, she's losing an $1,100 deduction. which is going to add to her itemized deductions, which is going to reduce her taxable income. So, does it come down to whether or not she really thinks her stuff is worth $6,000?
But designer lines really worth $10,000 to $12,000 a piece?
Right. To begin with. Exactly. And how much is an appraisal going to cost? What's the tax benefit of that $1,100? This isn't on here. What do you think? Now, I mentioned on your on your itemized deductions, it says that for any gifts over $500, you need to fill out a 8283. Do you think, for us regular people who don't have $6,000 in designer goods on our tax return, do you think there's an abnormally large number of items that fall just under $500 so they don't have to fill out an 8283? Remember when I told you one of the most common questions I get asked is, just put whatever you can for my charity, whatever that number is. That number is just under 500. That's what they're talking about. Whatever it is, they don't have to fill out something that requires them to provide documentation. That's what they're talking about. Because that somehow has been circulated as, that's okay. And my answer is always, I need to see something that you gave donations. Did you give anything? Do you have anything? You know, and I'll get like this one Goodwill. I'm like, that's not $495, I can guarantee you. So, but that's that magical, if you ever hear someone say, well, just give me whatever it is that, you know, I get, I'll be like, what is that? And that's what basically say there isn't a number, okay? What did you give to clothing, or that's usually what the Goodwill, and what did you give to cash? And honestly, you can help them with cash. People forget some of the things they do. What did you give to church? Did you give anything to the Salvation Army? And they'll be like, oh, I forgot about them. You know, did you give anything to United Way at work? Okay, if they give it through their paychecks, probably not tax deductible here because they probably didn't pay tax on it through their paycheck. It probably came out tax deductible. But you can kind of prompt them, and they might be able to come up with $100, you know, just by you prompting them in cash. Do you have a question?
Yeah, I have a question. So if they think to put like 300 times the IRS aggregate, so
Right.
what they gonna prove to the IRS?
Okay, if they got audited for $300, which would absolutely shock me, but if they did get audited for maybe another reason,
Yeah.
okay, so they'd be looking for your Goodwill, like things that you can get from Goodwill. They'd be looking, if the children home come to your house, they'd be looking for those receipts. I can tell you what I do. It also helps me at the end of the tax year because I kind of forget what I did. All right, now I don't give as much now because my boys actually run into each other. They used to not go into each other, and my little guy wears through stuff, so it's not even Goodwillable anymore. But I actually write on the receipt, after I get it, I will go back and say 3 bags of whatever, and I'll put right then what I think it's worth. And I'll say 3 bags, $50, 2 bikes, $25, and a box full of kids' books, $10. And I'll just put that all on that receipt right then. Because if I just take the blank receipt and write 3 bags of clothes, it will come the end of the tax year and I'll be like, I have no idea what those clothes were. Were they the boys' clothes or were they my clothes? Because honestly, my clothes are worth more than the boys' clothes. What were the shoes? Were they shoes that they're probably going to give away, or were they shoes they're going to sell? You know, so that's what I recommend to my people that come to me and ask me questions, is I recommend they do that. Because that way, if they did get audited, they can actually show them, here's what I came up with. So my brother actually started doing that several years ago. He started putting the same thing at the top. He's not quite as detailed as I am, but he's not an accountant. He'll just put at the top, you know, $200, $400. But at least he's putting a number on it as soon as he gets it. So, all right, there's the chart I mentioned. All right, this one right here does not happen very often, but it's also very confusing when it happens to you guys. So casualty, theft, and loss on personal use asset. First of all, if you're reimbursed by the insurance, this no longer comes into play, all right? If you're not reimbursed the full amount, then it could come into play. But if you're reimbursed, and let's say it happens in November, and you don't know if you're going to get reimbursed, wait. Because, again, remember how I said, taking the deduction one year and claiming the income in the next, you will pay more on the income reimbursement next year than the advantage you got as the tax deduction on your itemized. So, it's not like it's huge, but don't do that. Just wait. So, casualty theft basically says that, and it goes online. If you're looking at your itemized deduction, this is line 20. It's its own little box by itself. There is a form, 4684. It's the decline in value caused by the casualty. What was the casualty? It could be fire, could be earthquake, could be someone coming in and breaking things. I mean, could be a lot of different things. My dad, when he was painting our stairs growing up, not dropped the paint all the way down the steps. Just took out the whole steps and the bottom of the stairs and the carpeting. We turned it into insurance, or we did. My parents did. But if he couldn't have done it, that could have been a casualty, right? I mean, okay, theft, obviously that's self-explanatory. So if you don't have insurance, you get to do the decline. What happened? All right, what was the decline in the value? So there's two things that have to happen. Number one, automatically $100 is deducted from your loss. That's called the floor. It's per casualty, each casualty. So unfortunately, if you have a couple casualties, now when you look at, I just thought of Katrina, which I know was a long, long time ago, but whatever the floods that have just happened, there's a lot of people that don't have insurance in those areas. This is casualty. They can put it here. But each one, if they got hit by more than one, is a separate incident. So it would be $100 off their loss. So if they lost $20,000 worth of stuff, now they're down to $19,900. Okay? I know. Okay. And then it's 10% of the AGI, okay, of sum of all the casualty for that they lost in that incident for the year. So it has to exceed 10% of their AGI. So again, if I make $100,000, it has to exceed $10,000, and then I get to claim that. So, in other words, the deduction is an aggregate amount of the casualty losses that exceeds 10% of AGI. So it's $100 per loss, but then you sum up all the losses together. If you have 4 losses, it's $400, but then you sum up all the losses together. So that's the positive. Each loss doesn't have to exceed AGI. The losses together have to exceed them. So if you got double whammied, that at least helps. And then you put that line on line 20. And then the last thing we have, well, basically the last thing we have is what's called miscellaneous. These are subject to only 2%, and I say that because it's the smallest one. So $2,000 on someone that makes 100, okay? Are you coming? We're still in income tax. Okay, sorry. So the things that fall under here are like employee business expense. So the person that I talked about who was the pet sitter, this is where she put her mileage. All right, so it only had to exceed 2% of her AGI. If you have a high AGI, you're still looking at $2,000. If you have a low AGI and you are something like a pet sitter, let's say, your mileage is going to well exceed that amount of money. Investment expenses, all right, that's the amount of money you spend in those investment activities. You can, your tax preparation fees, you also can include hobby losses and your other things. This is where you would put your gambling losses, okay? Your gambling winnings go on line 21 on the front, just as other income. Gambling losses would go here. So you can kind of see line 21 talks about the unreimbursed business expenses, employee expenses. You can fill out a 2106. 22 is the tax preparation. 23 is other expenses such as safety deposit boxes, that type of thing. And then it's subject to the 2%. I take that back. And then the gambling losses, I'm sorry, go on line 28. They're not subject to 2%.
So with other miscellaneous?
I think they just go under other miscellaneous. They're not going to be subject to 2%. Here they go. See, miscellaneous here. They're not subject to any floor. They're just added into your itemized deductions. So let's say you had $400 of gambling losses and $900 of winnings, but you didn't itemize, then you just get to claim $900 of winnings. So that's the bummer, is the only way your gambling losses help you is if you're itemizing. Yeah. But they go here. So then you come down to here, and this is where you got to make the decision. Do I take the standard deduction or do I take the itemized deduction? So when we're looking at this, our married filing jointly, you guys should all know our standard deductions. We've talked about this. Remember, the one thing you get with the standard deduction, especially as you get older, is you get the additional age and blindness. So you could get $12,600 for being married. Then you could get $1,250 for being the age. Plus, you could both get $1,250. So you could get $2,500 added to your $12,600. So it's going to take a lot of itemized deductions to exceed. You'd be at $15,100. So your itemized deductions get harder and harder to beat as you get older if you don't have a house or if you don't have medical expenses because your standard deduction is so high. And the hard part is when you have people come in, they want you to do their itemized deductions to see which ones. They don't want you to just say, I looked at it, I really don't think you have it. They want you to do that. Now, one of the things that if someone comes to you for tax planning that you want to talk about is tax itemized or tax bunching itemized deductions. The first thing I want to tell you about this is you need to make sure the person talking to you realizes it doesn't make an advantage every year. It only takes your itemized deductions and puts them in 1 year over the next. So it's really for somebody who itemizes 1 year and does standard the next, or standard 1 year and itemizes the next. So they go back and forth. So if they're always going back and forth, then tell them to look at things and say, well, you know what? If you're not always itemizing, then in a year that you're not, try to save some of those house payments or medical payments or something and wait and push them into the next year. And maybe you can itemize in that next year if you wait and pay your taxes in the next year, do your property taxes in that year, pay a couple bills late in that, however you want to get them to what they call bunching. But you want to make sure they understand, which I don't think H&R Block and some of those do a great job at, is when they tell you to, one way to get a better refund is to pay your January house payment in December. Because then you have your interest from January and December, which ups your mortgage interest, which ups your refund. That's true. But you know what happens next year? You have less interest unless you go ahead and do the same thing again. So it's great, but you're going to have a ripple effect unless you understand what you're doing. So bunching is good for people that jump back and forth between standard and itemizing. Personal exemptions are subject to phase out if you're a high income level individual. And that would be it. Now,